I'm Clara Hermit and this is Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you doing?
Very well, Clara. How are you?
Yeah, not too bad at all.
Good.
Did you have a nice Easter?
Can we move on?
Yeah.
Don't worry, guys. Nothing serious. Just a bit of a back problem.
Few problems with the back. Okay, Russ, apart from the back, what's the fuss?
Okay, moving on from the back, and yes, please do. There's an absolute deluge of company results, trading statements, macroeconomic figures coming out in the next week. But for me, the real fuss is all going to be about ore, chips, and American output. And that's because we've got a trading update from mining giant Rio Tinto, first quarter numbers from FTSE 100 technology stock ARM, and on the macro side, durable goods orders from the US of A.
We're not talking about the kind of chips that I like, but
Nope.
Let's start with some shock and awe and go with Rio Tinto.
Very good. Yes, Rio Tinto, Tuesday the 21st, we've got the first quarter operations review. Chief Executive Sam Walsh will outline production growth across all of the mining giant's key commodities. Now they are iron ore, copper, bauxite and coal. And he'll also update full year guidance for output for all of those areas. Now iron ore is going to be the focus, I think, because the price of that commodity has collapsed. It's gone below $50 a tonne from over $100 a year ago. And as you can see from the chart behind us, that has started, or is, weighing upon Rio Tinto's share price as well. So despite that, Walsh has brushed aside calls for production cuts and is actually pressing ahead with increases. Now, output rose 12% in 2014, and that has Rio and rival BHP Billiton, as far as I can tell, trying to hammer some of the competition and make life thoroughly unpleasant for them. Research from investment bank UBS, actually my former employer, argues that many miners are already losing money at $47 a tonne, but it thinks Rio and BHP won't go into the red till they get down to around 35, so they can keep the pedal to the metal, if you'll pardon the expression. Now, the strategy may be working, as one Aussie miner, Atlas Irons, already announced a suspension of iron ore production at 3 of its mines in Australia.
So, what are the headline production guidance figures we should be looking for?
Yeah, again, iron ore is the biggie after that big increase that we had last year. Rio's looking for 350 million tonnes of production this year on a 100% owned basis. That's another 20% hike. So that's, into a glutted market, that's a serious issue. Elsewhere, looking at increases of around 3% in bauxite and then 15% drops in mined copper and thermal coal. Other numbers to watch, the cost-cutting target of 750 million US dollars and the capital expenditure budget. That's due to come in below $7 billion this year against $8.2 billion last year. And just as a final point, in the same week, we've got statements from BHP Billiton and Anglo American. So you'll be looking at BHP on the 22nd and Anglo's first quarter numbers, I think the day after the 24th, sorry, in fact. So then, again, you'll be looking at the same numbers, CapEx, cost cuts and output.
Right, okay, so it's looking like a busy week. Should we move on from mines to chips?
Yes, we will. And ARM, Cambridge's finest FTSE 100 company, Q1 numbers due on Tuesday the 21st. I'll get my timing right. And the timing, in fact, is very interesting because a number of global chip makers have come out with some, frankly, pretty disappointing statements. Intel had a monster profit warning on the 3rd of March, for example. And a lot of the chip makers have been citing slacker demand for PCs, tablet computers, and even smartphones, which is quite interesting. Now, remember, ARM doesn't make chips. It doesn't even design them. It creates architectures for microprocessors, which other customers used as the basis for their own products to save them time and money. So ARM gets a license fee and then trousers a royalty every time an electronic gadget that features one of its a chip based on its architecture is sold. 4 to 5 cents a go. And if you think of how many smartphones, it adds up. Great stuff. Now, so that model, the spread of clients and spread of end markets, tends to insulate ARM from the worst excesses of any chip cycle downturn. So let's hear what boss Simon Segars says. He's forecast 10% sales growth in dollar terms for Q1, and frankly was pretty upbeat last time he spoke. He might even say there's no chip downturn and brush that away. Now, the stock has had a wobble, as you can see, probably because of those US and Asian chip makers' comments. So the market's going to be looking for a little bit of reassurance, I think.
Okay, so that just leaves us with the latest batch of American economic indicators.
Durable goods, and it's a very, very important one, and that's coming out on, as usual, one of the penultimate or the last Friday of March, on this occasion, Friday the 24th. Recent US data has been spotty, I think it's fair to say. We've talked about those sentiment surveys before. They've all blamed grotty weather in February. Right, let's see, because this is the March durable goods order. No excuse this time. And also note that from the chart behind us, that order figure has already fallen 5 times in the last 7 months. And the February figure was pretty much flat year on year. So that's not that great. I think a decent number is needed to persuade the market the US economy is on track. Although perversely, of course, bad news could be good news, because if it's a rotten durable goods number, the market might just think, great, that'll put Federal Reserve interest rate hikes on the back burner, more cheap money. The money's got to go somewhere, and possibly equities will be one place that people would look.
Thank you for that, Russ.
Pleasure.
And thank you to you for joining us, and we'll see you next time. Goodbye.